So hopefully we are back live now. I just had a complete and utter blackout on the channel. So basically I'm going to take the old one off and we're going to start anew. And I do apologize for that, but had to do a quick electrical work there to bring us back online. No big deal. I will take this opportunity to kind of introduce the channel a little bit for a lot of the new folks who have come to the message within the last 6 months or so. We've had quite an influx on the channel, that of which I'm very happy about. My sole purpose when I started the channel was really just to talk to more people than I could talk to individually. And I do speak with a lot of people in my day-to-day interaction with folks. You know, just trying to really reach a lot of people with regard to how I go about approaching the stock market. It's really not as difficult as a lot of people think that it is, and a lot of those barriers to entry keep a lot of people from becoming a participant in the stock market. You guys can appreciate some of the language that I actually use, you know, through the channel in talking about, you know, just becoming a participant in the market. Okay, you don't have to be an analyst. I know there's a lot of preconceptions. I've got Ernest popped in here. How are you this evening? Sorry about the technical difficulties. We're going to get into the nitty-gritties. I do have a lot of topics that I do want to address with you guys. This live forum kind of allows me to address and evolve some of my opinions. If you go back and you watch some of my starting videos when I started putting content onto YouTube, you will notice there that there's been a very, very consistent theme in the type of account that I offer for you guys. And I've really tried to offer a message that's been free of rules, okay? And I think a lot of people are able to sit back and say, okay, well, what does Ryan do? You know, what are some of the fundamental strategies that he deploys to kind of help me, you know? And I'm not one of those folks that advocate for tuning into a channel like mine or any other channel on YouTube or prescribing to any one philosophy or approach on the stock market. That's what people really need to understand, is the more that you understand about the totality of the landscape out there and the amount of options that you have to really tailor a program, define the amount of exposure and risk that you want to take on to become a participant in the stock market. Once you get that plan in place and you get that defined for yourself, you're going to be so much better off, and it's going to be so much easier to resonate with why it is you became an investor in the first place. So I'd like to kind of talk a little bit about the stock market pulls this week. It feels to me to be on shaky ground. You guys know that I took some liquidation last week. I'm down to 50% exposure in my portfolio. I've probably got around $100,500 actually still exposed to the stock market, but I've actually pared back quite a bit of cash on the sideline from my portfolio. You guys know that I took some bond exposure as well. I've been wanting to do that for a while. You know, I could be wrong. The stock market could continue to go up. I've actually validated my decision since last Wednesday. It seems like the stocks are pretty volatile. If my pulse of the market is correct, I just think there's becoming a little bit more defined headwinds. And if you guys haven't noticed how shaky technology has been, it is and always will be my favorite sector to invest in. And I am invested in some of these stocks. I mean, I owned Facebook up at 210, and I've held it all the way down to this 160 level. And I know some of you guys are actually starting to be attracted by taking some position in Facebook. And you can do that. I just recommend that you take it in pieces, and whatever piece that you take from Facebook, you really need to be careful. You need to be willing to take that into some downturn. Okay, be willing to wait this thing through. But I absolutely think Facebook is probably a broken stock, and it's the same company it was a month ago, right? And we see this play out all the time. Okay. I'm sure Tesla will get brought up in the group this evening. I found that was really funny. You guys know my opinion on Tesla as a company. I do want to address some of my criticisms about M1, working through that platform over the last couple weeks. I do want to address again the account order. I do get a lot of people hitting me up on what account they should start for first, or when should a brokerage account fall into the order of precedence on which account you should start first and second. And if you do own a Roth, a 401k or a 403b, should you open a self-directed account or a Roth IRA account on top of, your existing 401k? All right. And I would like to get into some of that investing order. I think that'll help a lot of you guys, because a lot of you guys are hitting me up and saying, hey, I've got a 401k. What should I do? And there are absolutely some options there for you. You don't always have to rely on the restrictions that I find all the time in 401k accounts. It really allows you to diversify your holdings, allow the 401k to work, and then go ahead and put that Roth IRA account to work as well. I got hit with a question through the subscriber base this evening. I just responded to it with regard to the difference between a Roth IRA and a traditional IRA. This is one of those things. I got $4.99 because I got a complete blackout tonight. Thank you for the tip. I really appreciate that. 1979 wood in the house. I don't even know how you guys do that. It's really cool. I appreciate you guys. But those are going to be some of the topics tonight. I'm going to offer some of my stocks for less than $50 for some of you guys that are beginning investors. I will premise this, that's more for entertainment than anything. It took me quite a significant amount of time being a mutual fund investor before I even bought my very first stock. Okay. And a lot of you guys are you're wanting to jump in with both feet and become a stock investor. Okay. And keep in mind the risk tolerance that's necessary to be a stock holder is significantly more than if you just enter into ETF or passive investings. Okay. I just did my release this week about ETF, slow passive growth, and that fits a lot of people. And what people don't understand is if you start in the stock market and you say, look, Ryan, my risk tolerance is fairly low, but I understand the importance of taking on some risk, the ETF will give you that nice, diversified, balanced level of risk. And there's nothing that says that you can't be an ETF investor for a few years to kind of get your feet wet a little bit before you start adding some single stock to the portfolio. Give yourself a chance a little bit, okay? And my warning is this: if you're going to jump into single stock right at the beginning of your investing career, you need to make sure that you've got some manufactured conditioning upstairs, because it's going to take some fortitude. You're going to have to fight through some market downturns, because I'm telling you guys, over the last 10 years in the stock market, it's been really, really easy to be euphoric in nature and just buy stock. You can trip and fall in the stock market and make money. And there are going to be some folks, even through YouTube, that are going to have a very rude awakening when they find out that stock markets, they go down, and they can go down every single day, and they can do it for years at a time. Okay. It's very painful when the stock market goes down. And that was really a lot of the reason why I put forward the message that I did last week on defensive positioning. And I hope a lot of you guys took that message in context. Okay. I hope you took it in the right manner, because all I was really doing is portraying to you guys what I was actually feeling with regard to the pulse of the market right now, wanting to safeguard some cash. Okay. Now, what I did isn't necessarily great for you. Okay. It may not fit, but it's at least something to always ask yourself that question. Am I prepared for a downturn? Am I prepared for a downturn? What additional things can I do to prepare for a downturn? Is there anything that in my budget that can be cut away? Is there any more attempt that I can take at building cash on the sideline to be that much prepared to take advantage of a downturn if it happens, right? all while you continue to keep some exposure to the stock market at all time, okay? To make sure that you're always participating in the melt up, okay, if that does happen. But since last Wednesday, the stock market has been fairly shaky, in my opinion, and I've watched it really kind of come off of its highs now. And I tell you what, with the I just looked over to the right, and I've got one of my brothers. I've got one of my brothers in the group. You guys need to please say hello and congratulate one of my brothers, Brandon Oxton. He is serving right now in Hawaii, and he is a new father. So you need to congratulate him because he's got his new son, and who's been in the world for all of about, what, 4 days now. So congratulations to you, my friend. Congratulations. I'm so happy for you guys. It's very cool to see you kick into the group here. We are kind of looming. We've got a storm looming on the coast right now here in Virginia. So certainly pray for us and, wish us well. Hopefully we can get through this thing. I'm hoping one of the projections actually pushes it offshore. You guys know me. I used to be a commercial fisherman, and you can't control nature. You do everything you can do to control what it is that you can do, and Mother Nature will control the rest. And we're right here on the edge. It's been a pretty rough September already. We're at the peak of hurricane season. So not to get too off topic, but barring any more technical difficulties here on the channel, I do apologize again for the power outage. I will probably take that other feed off and just go with this. So hopefully we can stay online, and hopefully I can have enough power coming through the Apple computer tonight to get this live feed done for you guys, because at the end of the day, the Independent Investor channel is really all about you guys and acknowledging and strengthening your guys' financial portfolios going forward. Asking those scary questions of me. Please do not be shy. Ask me those questions. What would you recommend as a first ETF, Ryan? What exposure would you look at to build your portfolio? Ryan, I've started my account. I'm good to go. How much do you need to start? Some of those very simple, fundamental questions are some of the questions that you've got hundreds and hundreds of people out there wanting to ask the exact same question. And for whatever reason, they don't want to ask it. And I love answering questions like that because it benefits the masses. All right. So I really, really want to encourage you guys to treat this as an open dialogue, bounce ideas off me, take advantage of the opportunity, guys. It's just about an hour to an hour and a half every Friday where you can kind of bounce your program off of me. If it becomes a little bit too much, certainly want to kick over to the Facebook group. Where I've got a ton of folks. I've just awarded some folks some editing privileges if they didn't notice. Ernest is one of them. He is now an editor. I just pushed that permission through. So he'll have the opportunity to not only go on there and edit content, but also kind of police the site, because you only get really one chance. And if you start to spam the group, I kick you out. I've already done that to about a half a dozen people. It's not one of those places that I expect is going to be used for any other purpose other than just to get questions answered for beginning investors and to put information on there that is useful to new investors seeking out that information, guys. We're looking to blow the lid off of information that's seemingly not available, right? We don't teach this stuff in high school. We sure as heck don't teach it in college, all right? And you're stuck to go out there and pursue a career in the search of financial security, and nobody really understands principles of budget discipline, the principles of what cash benefits and drawbacks have, and what especially the benefits of being a participant in the stock market have to offer, and what compounding interest can mean to you if you allow that program to compound over time. Obviously, the earliest you want to get started, the better, but I always contend that it's so important to get started correctly in the stock market as opposed to get off on the right foot and think you're doing the right thing, but you're actually investing or getting off on a program that's built on false pretenses, okay? So you really need to be careful with that. Do your research. Hit me up with questions. If you think I'm wrong, certainly you want to challenge me. We take the Roth IRA idea to a new level, because I just feel like there's way too many people out there who are unknowingly doing the right thing by starting a retirement account. They start a Roth account so they can have tax protection down the line, right? Only to subject that individual account value to the mercy of a managed account, okay? And that's where the managed account comes in the back door and starts to charge you for things that you will not be charged for in a self-directed account, okay? Dollar cost averaging, annual fees, dividend reinvestment, okay? We talk about the drip all the time. Those account features are charged in managed accounts because they've done everything they can possibly do to find every angle to take money out of your right. That individual retirement account is your government bestowed upon right, okay? That's why they cap it at $5,500, because they say, look, this is your maximum benefit. So for you guys that are on the fence about whether or not you want to start a Roth IRA account, okay, think of $100 as being almost 25% of your monthly benefit. Think about it that way. Think about pledging $100 a month toward a Roth IRA. And in essence, what you're doing is realizing 25% of your value or your benefit, right, back to yourself, okay? And that's kind of the way you need to think about it. A lot of people are like, well, I don't have an extra $100 in my budget. I say all the time that I started with $25 in my account. You know, I started with it. And when you start that, all you're doing is starting the mental conditioning necessary to get over the psychological barriers that people have to work through when they start. And trust me, guys, so quickly you will go from the $25 contributed, and a couple months will go by and you'll be like, wow, I don't miss that money. Let's up it to $50. Wow, I don't miss that. Let's up it to that $75, or let's up it to that $100. And something will happen psychologically along the line is that it will become part of you. Your program, you will buy into it so much that it will become part of you, all right? And you won't sacrifice that program for anything, all right? It'll just be money that you pay yourself first, and it goes in there, and you'll always be looking for ways to fine-tune and improve your program going forward, right? So that's the evolution of going from, remember, a $25 investor or a contributor not really knowing why to actually desiring to do that for yourself, all right? So guys, welcome to the group. I really appreciate everybody kicking in here. Again, I apologize. I've got Benjamin Levy. He's always hitting me up. Hey man, I'm waiting for you to do that topic for me so I can kick over and comment for you. Benjamin Levy, he owes me a YouTube video, man, to all of his, I think he's got 1,200 subscribers now. I think he's doing pretty good. Doing quite good. You need to blow that video out on compounding interest for your guys. To show them how good we're doing. Elon Musk, not a good look. No, I agree. Again, it's not one of those things that I advocate for. Look, guys, if we're going to invest in single stock, there's been a few stocks that I haven't touched through this upswing in the stock market. Johnson & Johnson is probably the flagship company that I have held indefinitely my whole life. And I can't tell you how much money I've made with Johnson & Johnson. I've always had it set to reinvest dividends, but it is a fabulous company. I have traded in and out of Apple. I had the last trade I had was a significant upswing in Apple, so I took some profit there. UTX, I've been kind of long there. I really think Honeywell, it looks very attractive right here, guys. But I'm going to offer my stocks under $50 a little bit later in the discussion here. I want to get to some of the comments in the group here because that's really why I do this, is for you guys. Avi A says wild week. It has been. I really feel like the stock market is kind of on shaky ground here. So for you guys that are looking to enter some new dollars to this stock market, please be careful, okay? We use terminology like scaling into the market, and we use that to say, look, if it were a 30 or a 40% recession or a bear market, I'd be telling you, if you had lump sums of $10, $20, $30, $40, $50,000, I would be telling you to go ahead and jump in with both feet, okay? I cannot in good conscience do that now, All right. If you start a program now at market highs and you buy 10 shares of VOO, which is Vanguard's S&P 500 fund at $266 per share, you're talking about a $2,600 starting position. Start a max funding schedule on that. If you want to do $200 or $250 to dollar cost that, average that up, I think that's a prudent move in this position. All right. If you wanted to do 70% in the VOO and take that additional 30% and go with a stock market ETF like VO, which is the mid cap version of the ETF from Vanguard. And finally, I recommend VB. It's the ticker symbol VB, which is the small cap version. Okay, so you can fill the top 30% in the portfolio with those two smaller holdings, and then the bulk of your portfolio can be the S&P 500. But do you guys kind of understand a little bit how I'm talking about scaling into this market at an all-time high? Because if it does end up taking a haircut, that's when we're going to step in and buy the market a little bit more heavy. Okay, right now is not an opportunity to step in and buy the market heavy. It's just not. Okay, that is my opinion. All right, I could be dead wrong. All right, and I would love to hear it more from other YouTube channels with admitting that we don't have all the answers. Okay, nobody does. Nobody does. All right, I'm just as susceptible to risk in the stock market than anybody else. The thing that makes me sharp is I've lived through downturns. Okay. And by living through certain downturns or corrections in the stock market, you get wise over the years in understanding that you have to prepare for those downturns ahead of time. Okay. You can't allow the stock market to go down and then panic and sell then. It's done. The move is done. It's over. Okay. And the prudent move at that particular time, if you do get caught in one of those severe downturns, is to hold and wait for an upswing. Okay. That's where the discipline comes in, is always preparing for a downturn proactively as opposed to being reactive on the stock market. Strong moves is what's going to make you powerful over time in the stock market. All right. Added CRM Salesforce to my portfolio this week after Capital Hearing beat down the sector. I think CRM Salesforce is probably going to become the darling, actually. It is my favorite cloud computing company. You guys know that I added a small position in the M1 account on CRM Salesforce. I actually reversed the allocation to CRM Salesforce to be my highest of allocations. And I actually drew back on my allocation to Amazon. It's actually the least amount in my portfolio. And that ended up just being a darling of a move, no doubt, because it pulled back huge this week as all technology pulled back. Apple got caught up in the mix. Facebook, probably some of it justified, not everything justified in Facebook. The chips got annihilated except for AMD. AMD's been on quite a nice run. So if you guys have owned that, congratulations on that stock trade. Just be careful with it. You guys are going to find that Intel and Cisco are a couple of my stocks below $50 that I would highly consider looking at as these dollars start to flow from growth tech to value tech. Where do you think they're going to go? Cisco is right there at the top of that list. Okay. So good move on CRM Salesforce. I've got Average Joe Investing, who, if it's the same Dave that I saw through my Facebook feed, I also owe a congratulations. You guys got all kinds of life events happening for you. And I just want to give a shout out to Dave. Congratulations, Dave. It was the greatest thing that ever happened to me in my life. No doubt about it. It keeps getting better and better. So congratulations. He just got married this week. So I'm very happy for you. Thanks for coming in and kicking into the group on a Friday, Dave. Thank you. Welcome to you. I like to know how many shares are to muck to have like 100 or 1,000 shares. But that's a fantastic question. That is an excellent question for somebody who looks at the stock market and says, what is appropriate? Should I buy 1 share of Google? Or should I buy, 100 shares of AT&T? Okay. I think my advice to you guys is going to be very, very simple. And this is what I did when I started. All right. I always looked at 5 to 10 share positions when I started. That's it. I talk a much bigger game now. I have no problem with entering into share positions at 50 to 100 shares for a position. Okay, like a position, for example, in Mondelez Foods or Cisco right now, I wouldn't buy less than 100 shares. I would buy 100 shares, $4,000, $4,700. That's good to go for me. For you guys who are just getting started in the stock market, take that $47 stock price and look at it as a multiple of 10. Okay, so a company like Intel trading right here at $47 a share, 10 shares will run you $470. And that is some of the conditioning when I start to look at the stock price. Look at a Comcast right here at $36.50 or $36 a share. 10 shares will run you $360. Okay, do you have to go out and buy 100 shares of Comcast? It depends, all right? It really depends on what you're looking to do with your portfolio. Don't get too crazy if you've got less than $10,000 to invest in the stock market, thinking that you can invest everything and buy the entire stock market, all right? I kind of have set a general rule of thumb for new investors that it is so much more important for you to get up to that first $10,000 invested in the stock market before you even start to think about adding cornerstones, okay? Now, a lot of you guys are like, yeah, right, Ryan, whatever. I want to buy stock, but then do it. That's fine, all right? If you want to add single stock exposure to your portfolio, go ahead and do it. But my rule of thumb for new investors is to prove to yourself that you can start that diversified base and allow yourself to dollar cost average, dividend reinvest those dividends in your retirement account, which you can do with your ETFs, and prove to yourself that you can grow wealth, okay? Prove to yourself that you can grow wealth, all right? So if you're looking at starting amount of $1,500, I really wouldn't venture too far away from starting a nice position in the S&P 500. I know I sound like a broken record, okay? But it's getting you the best, most diversified exposure to the US stock market at the lowest fee, all right? And it's getting you started. It's the hardest thing to go from nothing to something. And that is the best, most prudent way that I can get you going from nothing to something in the most responsible way, okay? Because when we bridge these two together, I'm giving you diversification, safe exposure, low fees, put it in a self-directed Roth IRA, wrap it in a bow, and I can't do any better for you, all right? If I knew any better, trust me, I would share that with you openly, all right? But this is exactly what I do. So when you're looking to buy single stock in your self-directed Roth IRA account, and there's a stock that you absolutely want to own, all right? And you've got, let's say, $5,000 in the S&P 500, or you've got the S&P 500 and you've got a good mid-cap ETF, right? You've got VOO and you've got VO and you've got VB. Let's say you've got all three of those ETFs and they're working for you and they've paid you some dividend reinvestments. You've got some partial shares built up in there and you say, Ryan, I want to add a position like a Pfizer, okay? How many shares should you start with? Okay, that's an awesome question. And that's when you start to kind of get into my sector recommended allocation. All right. You guys all know healthcare is right around the 15% mark. All right. Where no more than 15% of your total overall portfolio holdings, whether you have $100,000 or $1 million in your account, should be devoted to any one sector. Okay. So if you want to take a 10 share position in Pfizer and you want to invest, you know, $400 into Pfizer at a 10 share position, or maybe a little bit more, Pfizer's a great company. That's one of those stocks that I'm going to recommend that are below $50, pay you a 4% dividend. And the cool thing about a stock like a Pfizer or a Merck or an Intel or a Cisco is that when you own those good companies through the ETF conduit, all right, you only own a fractional share of that company. Okay, so if you own the single stock in that particular portfolio, you get 100% of the appreciation. You get 100% of every dividend that you own. You are legally a shareholder in that company. Now, you're still a legal shareholder through the ETF, but you have to understand, instead of owning 1.6% in the ETF, you own 100% of it if you own 1 share of it or 10 shares of it, okay? 1 share is your multiple, 5 shares is your multiple, 10, 50, 100, etc. All right? You're going to find that there is no better way in the stock market to build wealth than single stock exposure, okay? But I can't openly preach that to my subscriber base without having new investors resonate with the importance of diversification, okay? Because the importance of owning the diversified base over here is because if you do own that Pfizer, remember how I talked about you own 100% of the appreciation? Well, you also own 100% of the depreciation as well. All right. And it's that much more scathing when a great company takes a haircut of 20%. And now you're kind of stuck holding the bag, having to wait this one out or buy more shares of it. Okay. And all the while, this diversified base over here is still working for you. Okay. Because you put your eggs in many baskets over here. You've put your eggs in one basket. And I just use Pfizer as an example. Okay. But I could really talk at length about that. I may make a YouTube video on that particular topic because determining the number of shares is really relative. I've never owned more than 10 shares of Amazon, you know, but I was trading Amazon when it was back around 1,000. It was $10,000 every time I traded a 10-share block of Amazon. So that's really tough. There's been occasions where I've done a little bit more isolated, quick trades with multiple hundreds of shares of stock. I think I bought 1,000 shares of Comcast one time, or 1,300 shares of Comcast. That was a big, big purchase, but not very often. Not very often, and I don't really advocate for it. And I think if you just approach portfolio building as just that, and you're looking to build, you're not looking to own it all at the same time. Okay, look at it this way. If you buy a few shares of Pfizer, like 10 shares, look what you're going to be able to do if you hold those shares of Pfizer for a year, and then you want to add another piece to your portfolio. Maybe you want to add a discretionary name or a technology piece to that portfolio. And now you're happy with your Pfizer holding. Now maybe you want to add some Apple Computer to your portfolio, or maybe you're a conservative investor and you want to add some Cisco, right? And now you've got 2 monster dividend payers in your portfolio. That's portfolio building 101, guys, all right? And that there's no right or wrong answer to it. But I hope I've taken a good crack at that. That was a very, very good question. It's really relative to the amount of money or capital that you have in the portfolio, which should determine how many shares you buy of a particular stock. And I hope you don't mean that by buying shares, 1,000 shares of a company that trades for $1 is better than buying, let's say, 1 share of Google, okay? Because buying companies typically that have less than a market cap, you guys know I don't even look at companies that have less than $1 billion market cap. And quite frankly, I don't even look at companies with less than 10 billion, all right? I'm looking at companies that have $100 billion market caps, guys, and they're not going to move the needle every day. You're not going to look at your portfolio and say, wow, I'm getting rich, okay? But what you are doing is growing wealth, okay? And you're doing it responsibly. And there is a big difference. All right. So awesome question. I really appreciate that one. Thank you. Depends what the shares are invested in. Absolutely. Hey, Ryan, what's up? Same old thing. Just coming on to address some questions and talk about my favorite topic in the entire world. I love portfolio building. And I feel like we're making a difference through the channel. I get that validation every single day through the comment base. And so I want to continue that reciprocated value because I'm really not that interesting to get on here and talk for an hour straight. I really want to make sure that you guys are getting your questions answered and you're getting some value out of striking up the dialogue about what's going on in the financial world once a week. So dividend aristocrats are the safest. They are. It's a super cool way to invest But you know, I always twist it a little bit and give you my perspective, okay? There is so many YouTube channels out there that are saying, yep, my dividend portfolio, here's my top 10 dividends. And I've done it too, but I do it differently, okay? I do it differently. If you take the dividends that are offered by most every YouTube channel out there and you put them over here, then you take mine and they're the exact same stocks, okay? They're exactly the same. All right. But they house theirs in their account and I house them in mine. I'll kill them over time. I'll kill them. And therein lies the message on the Independent Investor channel. It was self-directed method over here, whereas these guys are building their portfolios. I mean, Jeremy on the Financial Education channel talks all the time about him. All of his holdings are in a brokerage account. I think that's insane. I think that's insane. He's making one of the biggest fundamental errors in investing is choosing the wrong order of his account. He talks all the time that his wife has the retirement account. So at least half of the thing is smart. He's got his wife going on a retirement account. I can't understand why he doesn't opt for a retirement account himself. And then if he can max fund that, which he should be able to because he's making killer money through YouTube off of his subscriber base, then he should be able to max fund that and then roll that money over into a brokerage account. But throwing $120,000 at the stock market within the last 6 months, I think is extremely irresponsible. That's what he's doing. Yeah, so dividend aristocrats are the safest, but remember the type of account is all about where you house those assets. If you've got that self-directed account, you can buy those stocks all day. Johnson & Johnson, Mystery Queen, that's really one of my favorites. I think I'm only at about 45 shares, 46 shares of J&J. I've built it up very slowly over time, but I think it's one of the premier companies in the U.S. right now. It's been around forever. It's awesome. J&J is time tested and is a good investment right now. I agree. Jeremy loves it. He bought 10,000 of Tesla today. Doug Whitaker, Jeremy on the financial education. That's amazing. Are you kidding me? I'm blown away. Very rarely do I get speechless on the Independent Investor channel, but yeah, buying 10,000 shares, I think he's probably BSing like usual.